Hello and welcome, and we continue to focus on earnings. I'm Harsh Saita and we'll talk to the management of Capri Global with regard to their numbers. There's been a margin contraction which seems to be bothering the street a little bit. Also, OPEX has remained elevated, but the positive within the numbers is very strong AUM growth which continues, which is not new to Capri Global, and you're seeing credit costs absolutely very close to zero, in fact. And that will definitely be a couple of positives. So we'll talk about all of those, and we'll talk about FY25, what one can expect. With us, we have Mr. Rajesh, who's the MD CEO as always. Welcome, sir, to NDTV Profit.
Yes, thank you.
Right, sir, talk to us first off with regard to margins. I want to try and break this down a little bit more. Your cost of funds has gone up, yes. How do you see the margin picture evolving over FY25 and 26? Where would the normalized margins be at?
So if you look at that, the last 2 years have been the year of the expansion. We opened a lot of branches, and we have done a lot of technology investment and set up the Capri Tech office where 100 plus people are working, and onboarded various new technology systems, including core banking by the Oracle, our collection module, our data science team. So put together last year also about 112 crore rupees have been spent on the technology alone. There was a lot of branches we opened. So I think going forward, the branch expansion will slow down because we already reached the target number of branches. And then our technology spend, what we have done, we start contributing toward the better productivity. So the coming picture of 25-26, we clearly see that gold loan AUM will continue to increase, which is a high yield product. So put together all the fact of stabilizing the growth and lower spend in coming year on the new branches, which and plus technology contributing to the better margins, I think our margins will be improved. We expect that our spread will go back to about 6.8 around that, and with that I think our AUM is growing at the 50% pace last 2 years. So I think we are quite excited about the coming.
Understood, sir. Okay, so some bit of margin recovery definitely in the works. But your cost to income, which was the other piece you tried to touch upon, now has breached 70%. As you scale down sharply with regard to branch expansion, opening new branches and the like, where should cost to income start to taper towards in FY25, and where are you comfortable in terms of a number over the medium term?
So I think next year we are targeting a cost income ratio in the range of about 53 to 55%. And we are comfortable when it settles down in the range of about 47-48%.
Okay, so and how quickly will it get to 47-48? Because next year itself you are expecting sharp contraction, 10% plus just in terms of absolute number versus cost to income this year.
Yes, so I think next year we expect that this cost to income ratio will come down, as I said, around 53-55%. And the coming year to that, we expect it to come in our target range of 47-48%.
Okay, so in 2 years, this will scale down quite sharply. Understood, sir. Before I come to what this does to ROA, I want to try and cover what credit costs and how credit costs are really playing out. Because near zero credit costs this quarter. Is it an exceptional quarter? And where should credit costs typically lie at?
So credit cost, I think because of the higher PCR and provisioning, it has come to that level. But otherwise, cost should remain in the range of about 50 to 60 basis every year.
Okay, got it. And what does this do to profitability? Some of these metrics that you're working on. One is on gold loan. You've spoken about how gold loan goes break even. Maybe at the fag end of FY25 is my sense. Please correct me if I'm wrong. Second is, what does that do to your numbers overall? Where do ROAs therefore start to lie? Because ROAs have held up over 2%. but where do they go from here? Because there are plenty of levers for that ROA expansion.
So we expect that in the coming year, our ROA should come in the range of about 3%. Thereby, it means that our profit for the coming year should be in the range of about 450 crore rupees, because our car loan entity, which is done this year also well, will continue to grow. Our insurance tech platform should come in the play in the coming year, and we, with the help of about existing 400,000 customer, which will grow to about 800,000 customer in coming year, this good fee income contribution will also happen from car loan as well as the insurance income. Besides, as I said, cost income ratio will come down. So collectively, I think our profit should be in the range of about 450 crore rupees and ROE in the range of about 3%.
Understood. Talk to us about gold loans, because this is a segment which you're growing extremely quickly. What's the book size as of today? And where does it go in terms of the overall book size? And also talk to us about growth. Currently at 15,000 crore odd the book. Can you grow at 30% plus?
So we'll continue to grow at 25% plus, and this growth is not happening alone. There is a proper risk governance framework, there is a proper collection mechanism, there is proper investment in the technology, huge investment have been made in the technology side, and the branch expansion have been done, the addition of the product have been done. So with collectively of this, the growth is happening. Growth is not happening only in one product, and without any consideration to the proper risk mechanism being in place. You are seeing that our net NPA and GNPA have been behaved very in a controlled manner. So we believe that our even gold loan AUM, which is about 3,400 crore, is very minuscule in the overall scheme of things, and still we are in the range of only 5 crore per branch. If you talk about our competition, they are at 12 to 18 crore kind of a range. So still, I think a lot to be done here.
Okay. Talk to us about the breakup of the book as it gets towards the 20,000 crore mark. How would the book evolve between MSME and other segments, gold and the like, which you currently do, housing versus construction finance?
So I think if we talk about 20,000 crore book, next year gold should be in the range of about 6,000 crore. Our MSME should be in the range of about 6,000 crore. And our home loan should be in the range of about, again, 5,500 to 6,000 crore. And construction finance should be in the range of about 3,500 crore rupees.
Okay, so construction finance actually coming off, is it? Is that how one can look at it?
No. So this year we have closed construction finance at about 2,600 crore.
Sure. Okay. I get your point. Fine. And with regard to construction finance itself, absolutely any impact of the new regulations on your book?
So
provisioning related
still is a draft regulation, but because we as a company, we have a high PCR, more than what RBI has stipulated. Even though it comes, it is not going to impact our balance sheet, because there already excessive provisioning have been done. So without increasing any provision, we should be able to meet that guidelines in case it is brought in force.
Understood. So you are already well provided for. Yes. Even through to FY27, 26-27, which is when the full 5%, the current draft reads that way, of course, but the full 5%, if at all it is implemented as is.
Yes.
Understood. Got it. Okay. Thank you so much, sir. It's been a pleasure speaking with you, of course, in trying to break down these numbers. A larger conversation definitely warranted on the business and where does it go over the next 5 years. We'll probably schedule that at some point, but good chatting with you.
Thank you. Look forward.
Right. That was, of course, Mr. Rajesh Sharma of Capri Global, MD CEO, spoke to us about numbers and what FY25 expectations are. Time to slip into a very short break. More on the other side. Stay tuned to